When it comes to managing your finances, understanding the tools at your disposal is crucial. Loans and systematic investment plans, or SIPs, are two such tools, each serving distinct purposes. But which is better for your financial future? Let's begin by defining these terms. A loan is borrowed money that you must repay with interest. Banks, credit unions, or online lenders often provide loans. They can be used for various purposes like buying a house, consolidating debt, or funding education. On the other hand, a SIP involves investing a fixed amount regularly in mutual funds. It's a way to invest in the stock market without timing the market. SIPs are designed to encourage disciplined investing and build wealth over time. Understanding these financial tools' basics is the first step toward making an informed decision. Both options have unique benefits and drawbacks, which we will explore in detail. Taking a loan can offer several immediate benefits, making it an attractive option for many. One of the primary advantages is instant access to a significant amount of money. This can be particularly useful for large purchases like a home or car, where the cost exceeds immediate savings. A loan can also help consolidate debt. By combining multiple debts into a single loan with a lower interest rate, you can simplify payments and potentially save money on interest. This financial strategy can improve your credit score over time by demonstrating responsible debt management. Moreover, loans come with predictable repayment schedules. Fixed monthly payments make budgeting easier, as you know exactly how much you need to pay each month. This predictability can reduce financial stress and help you plan your finances better. Finally, loans can be a lifeline during emergencies. Whether it's unexpected medical expenses or urgent home repairs, having access to funds can provide peace of mind and financial stability. However, it's essential to weigh these benefits against the potential risks carefully. Despite their benefits, loans come with significant drawbacks. One of the most considerable risks is high interest rates, especially for unsecured loans. Over time, the cost of borrowing can add up, making it harder to repay the principal amount. Another issue is the burden of debt. Monthly repayments can strain your budget and limit your financial flexibility. This can be particularly challenging if your income fluctuates or if you face unexpected expenses. Living under constant debt pressure can also affect your mental well-being. Additionally, taking a loan can impact your credit score. Missing payments or defaulting on a loan can significantly damage your credit history. This can make it more difficult and expensive to borrow in the future, creating a cycle of debt that's hard to break. Loans also come with fees and penalties. Late payment fees, prepayment penalties, and other hidden costs can increase the overall cost of borrowing. It's crucial to read the fine print and understand all the terms before committing to a loan. Systematic investment plans, or SIPs, offer a structured and disciplined approach to investing. One significant advantage is rupee cost averaging. By investing a fixed amount regularly, you buy more units when prices are low and fewer when high. This averages out the cost and mitigates market volatility. SIPs promote long-term wealth creation. Regular investments in equity mutual funds can generate substantial returns over time. The power of compounding further enhances these returns. SIPs are flexible and accessible to a broader range of investors. Start with a small amount and increase as your financial situation improves. Automated deductions ensure disciplined investing without constant monitoring. Section 5. Disadvantages of investing in SIPs. While SIPs have many advantages, they are not without their drawbacks. One of the primary disadvantages is that they require patience and discipline. Unlike lump sum investments, SIPs take time to show significant returns. This long-term commitment can be challenging for those looking for quick gains. Market risk is another concern. SIPs invest in mutual funds, which are subject to market fluctuations. While rupee cost averaging can mitigate some risks, there's always the potential for losses. keeping a long-term perspective is crucial to weathering market volatility. Additionally, SIPs offer limited liquidity compared to other investment options. Withdrawing funds before the end of the investment period can incur exit loads and tax implications. This lack of immediate access to funds can be a drawback in emergencies. Another disadvantage is the need for continuous monitoring and adjustments. While SIPs are automated, it's essential to review your portfolio periodically. Changes in market conditions or personal financial goals may require adjustments to your investment strategy. Section 6. Comparing loans and SIPs in different scenarios. Choosing between a loan and a SIP depends on your financial goals and circumstances. Need immediate funds? A loan might be better. Instant cash can address urgent needs without dipping into savings. For long-term wealth creation, SIPs are beneficial. Regular investments grow significantly over time due to compounding. Ideal for retirement planning or funding a child's education. Section 7. Aligning financial goals with the right option. Your financial goals and risk tolerance play a crucial role in deciding between a loan and a SIP. If you have a low risk tolerance and prefer predictable payments, a loan might suit you better. The fixed repayment schedule can offer peace of mind and make budgeting easier. However, if you're comfortable with some risk and have long-term financial goals, SIPs could be a better fit. The potential for higher returns over time can help you achieve significant milestones, like buying a home or funding retirement. Consider your current financial situation as well. If you have existing high-interest debt, it might be wise to focus on paying that off first. Taking a loan to consolidate debt can simplify your finances and reduce interest payments, freeing up money for future investments. Conversely, if you're debt-free and have disposable income, starting a SIP can be a great way to grow your wealth. Regular investments, even small ones, can accumulate over time, providing a solid financial foundation for the future. Section 8. Practical advice for making an informed decision. Deciding between a loan and a SIP requires careful consideration. Assess your financial goals, risk tolerance, and current situation. This helps you understand which option aligns best with your needs. Educate yourself about the terms and conditions of loans and SIPs. Understand the interest rates, fees, and potential penalties. Research the performance of mutual funds and understand the risks. Consulting a financial advisor can provide personalized guidance. They can help you navigate the complexities and suggest a strategy. Professional advice can be invaluable in making an informed decision. Stay disciplined and committed to your choice. Regularly review your progress and make necessary adjustments.